Hi, everyone. I'm Amir Kessler, Director of Product Management at KOVRR. Today, I want to talk a little bit about the KOVRR methodology, how the KOVRR model works, and how does KOVRR do cyber risk quantification. So I'm going to share my screen, and I'm going to use a graph that we've created that shows the modeling process of KOVRR. I know this graph can seem a bit intimidating. It's a lot of details, but don't worry. I'm going to go one by one. I'm going to explain everything. And by the time I'm done, I'm sure everything will be quite clear. So let's start. KOVRR cyber risk quantification model explained. The first step that we're going to talk about is the global data curation. In order to create a quantification, which is essentially an assessment of what would be the damage from cyber risk for a company, the first thing that we need to know, even before learning about the company, is to understand the context in which the company lives or operates in. In order to understand the context in which a company operates in, we need to know everything we can about the world. That means understanding what vulnerabilities and exploits are there out there, cyber events, threat intelligence, what campaign is currently going, what type of companies are targeted, what type of events are they usually targeted with, and of course, what are the severity and the damage and the financial damage of these events. All of this is true for cyber attacks, but it's also true for third-party services outages. It is also a cyber event, even if it's not malicious. Part of the data that we collect is also about outages and failures and data leaks of third-party providers. Two special types of data that we collect as part of the global data curation is around insurance. We also have two solutions for insurance companies. And as part of that, these solutions, or better to say, as part of the cooperation with insurance companies, they share with us claims data. We get a very good visibility into actual events on which insurees claim their insurance companies for, they filed a claim, and we get that data and we better understand what's going on in the market. This is the base of the quantification, understanding what's going on in the world. From that, we create a view of the inherent risk of the company. When we talk about inherent risk, we're basically talking about two concepts, severity and frequency. Frequency can also be seen as likelihood. By knowing which industry you operate in, we can already give you a baseline of what we think is the likelihood of your company to experience an attack, and if it will happen, what would be the severity. Now, the reason why we can do that only by knowing your industry and understanding your inherent is because we collected all the data in the previous step, and therefore we already know enough to slice and dice the data we have to only focus on your company and have a view of your inherent risk. But of course, just knowing the inherent risk or just knowing the industry risk is not enough. We want to learn about the company itself. And the next step, what we do is we do company data curation. We do it in many ways. The user can input data. We have data adapters and integration with security vendors. We actually have another video just about that. If you have an attack surface management or any attack surface profiling, we can also utilize that. And at the end of the day, what we want to learn about is your technographic footprint, what type of technologies you use, the asset mapping and the company network structure. How is the network structured? Any cybersecurity and IT controls that you have in place and what is their maturity, and any information you have about custom damage types. If there are specific scenarios or specific damage types that you are worried from and you believe that will actually be a part of a cyber event, we also need to learn about that. We collect all of that data to again create a view of the risk. So again, severity and frequency, only this time it's the residual risk, meaning it's not only that we know it about the industry as a whole, but we create the severity and the frequency specifically for you after learning all of what we learned about the company. Once we have all of this data, we can actually go to the business impact analysis to know what exactly in financial terms will be the impact of a cyber event on the company. We're actually going to focus how exactly we do that engine part. The first thing that we do is we create automatically a bespoke event catalog. What is the bespoke event catalog? The bespoke event catalog is essentially a table, a catalog of all the potential events that can happen to your company. It doesn't include events that are not relevant for your company, but only the ones that are tailored specifically for you. What does that mean? It means that it actually models how the event propagates inside your network. It actually models only the technologies that are being used by your company. It actually models all of the crown jewels that you have in your network, and what will be the impact in case the event actually gets to these crown jewels. There's much more to talk about the creation of the event catalog, but I'll move to the next step, which is the Monte Carlo simulation. Once we created the event catalog, we now know what events could potentially happen to your company. For you specifically, we want to run a simulation in which we simulate next year 10,000 times. No one knows what exactly is going to happen next year. Maybe it's going to be a good year, no cyber events. Maybe it's going to be a bad year with many cyber events and even severe ones. Since we can't predict the future, we simulate 10,000 options, 10,000 ways next year can unfold. Of course, the simulation is directly derived from the information we know about the company, such as the event catalog. The simulated events in the simulation are the ones that were created in the event catalog, and those are the events that we actually run in the simulation. Once we ran the simulation, and for every simulated year, we decided which events are we simulating, the next thing that we need to do for each of these events is to understand what is the damage calculation, what will be the actual financial impact of each of these events on the company. To be able to do that, to be able to understand financial impact, you must break down cyber events into their cost components, their damage types. What does that mean? If a data breach occurred to the company, we need to know what exactly the company is going to pay for. What are they actually going to use their credit card, for example? What we do is we reflect as part of the model what exactly cost component we're taken into account as part of the model. For example, lost income or forensics or data recovery or public relation repairment or settlements or legal defense, and the list goes on. This one, cost and damage types, which is here with a different color, indicates that if the user wants, they can add additional costs that are not included in the default configuration of the model, because maybe a specific company has a specific cost that is unique for them and they want to be as part of the assessment. It's not a problem. You just add it here with a very quick or very easy estimation of what will be the loss, and we integrate that as part of the total assessment. We're almost done. Last piece I want to talk about is the key use cases. How do you actually use this model? I'll just focus around cyber risk communication. Once you have the risk in financial terms, you can communicate with stakeholders, with board members, with auditors. What is your risk in the same language that everyone describes, which is financial terms? The second use case, you can better understand risk mitigation. You can actually calculate the ROI of security controls by comparing how much they cost to how much they save from your quantification. You have a direct ROI here between the two. And the third use case is cyber risk optimization, speaking the language of insurance companies, which is the language of financial terms. You can compare your risk to your cyber insurance policy. You can better negotiate for a better policy. That's the third use cases. These use cases are further explored and further discussed in other videos that we have here. That's all. Thank you very much. I hope this was useful, and goodbye.